Hey everyone, and welcome back to The Explainer. Today we are diving into a really fascinating mystery that's unfolding right now in the medtech world. We're looking at Intuitive Surgical. If you follow this space, you know they are the undisputed global pioneer and absolute market leader in robotic-assisted minimally invasive surgery. Seriously, if you've ever heard of the Da Vinci surgical system, you know exactly who we're talking about. Real quick before we get into the numbers, just keep in mind that this explainer is strictly for informational and educational purposes. It's not financial advice, investment recommendations, or an offer to buy or sell securities. All investments carry risk, so always consult with a qualified financial advisor before making any moves. All right, let's get right into it. To really grasp the sheer scale of Intuitive Surgical, you just have to look at this one number. $132 billion. That is their massive market capitalization as of August 2026. This figure essentially cements their absolute dominance in the soft tissue robotic space, a category they've effectively ruled for over 2 decades. But here is where the story gets super interesting and, honestly, where our central mystery begins. Despite having this massive, untouchable footprint, as of August 2026, the stock is actually down roughly 37% from its 52-week high of $603.88, and it's off about 32% year-to-date. So, you have to ask yourself, how does a company this dominant experience such a severe pullback?
Well, let's start with part 1, the setup, dominance and success.
To figure out exactly how this pullback happened, we really have to look at their Q2 2026 financial performance, because it perfectly illustrates the sheer power of Intuitive's business model. Get this, they brought in $2.89 billion in revenue in Q2, and incredibly, a staggering 85% of that revenue, so roughly $2.47 billion, is entirely recurring. It comes from the instruments, the accessories, and the services required to actually run these machines. So they aren't just selling expensive capital equipment and walking away. They've built this massive economic moat where every single system they place generates a continuous, predictable stream of cash. And you can see how that recurring revenue translates directly to year-over-year growth. They jumped from $2.44 billion in Q2 of 2025 up to $2.89 billion in Q2 2026. That is a massive 19% top-line jump. But wait, it actually gets better. They didn't just grow their revenue, they grew their profitability even faster. Their non-GAAP net income came in at $1.00 billion, or $2.80 per diluted share. That represents a 28% year-over-year earnings growth. They basically crushed Wall Street expectations on both the top and bottom lines. And if you want a literal masterclass in operational efficiency, they delivered a 42% non-GAAP operating margin. That is a phenomenal figure for any hardware and services company. Plus, the underlying utilization metrics were just as strong. Global procedure volume grew 16% overall, procedures using their flagship Da Vinci systems grew 15%, and procedures for their newer Ion endoluminal system, which is used for minimally invasive lung biopsies, surged by an unbelievable 36%. They placed 468 Da Vinci systems in just a single quarter. Basically, everything was firing on all cylinders. Which brings us to part 2, the twist, the market reaction.
So you've seen the numbers, right? A 19% revenue beat, massive procedure growth, and these absolutely staggering margins. Which brings us to the earnings paradox I really want you to think about today. If the numbers are so objectively, undeniably good, why did Intuitive Surgical shares plummet roughly 11% in the session immediately following the announcement? What did Wall Street see in this report that completely overshadowed such a massive beat?
Let's figure it out in part 3, the investigation, unpacking the headwinds. When you peel back the layers of the earnings call, you find 3 specific culprits that seriously spooked investors. First up, unchanged guidance. Even with that 16% overall procedure growth they just delivered, management decided to keep their full-year 2026 Da Vinci procedure growth forecast right where it was, aiming for a midpoint of about 14.5%. Investors were heavily banking on an upward revision, and when they didn't get it, the disappointment was pretty immediate. Second, slowing U.S. growth. And third, significant headwinds in China. Let's break down those last 2 points because they're really important. Okay, the crucial point regarding the US is that Da Vinci procedure growth moderated down to 12% in Q2, which was a drop from 14% in Q1. Why is that happening? Well, management pointed to 3 things. First, patients are simply deferring non-emergency procedures. Second, the expiration of enhanced ACA premium subsidies is starting to affect insurance coverage for some folks. But the third reason is definitely the most surprising, the massive, explosive rise of GLP-1 weight loss drugs. Because these drugs are just so effective, Intuitive actually saw a high single-digit reduction in U.S. bariatric surgery cases. It's crazy to think about, but medical innovation in one completely different sector is actively eating into the surgical volume of another.
Meanwhile, overseas, the climate is also proving pretty difficult. CEO Dave Rosa specifically called out their ongoing struggles in China. Intuitive is facing lower tender activity, which basically means fewer hospital contracts are going out for bid. On top of that, they're dealing with rising domestic robotic competition and having to navigate some really complex, policy-driven pricing pressures from the Chinese government. So these international hurdles acted as a major drag on the overall sentiment, even despite the really strong global revenue.
But hold on, it's not all doom and gloom. Let's shift to part 4, the rebuttal, future growth catalysts. As any seasoned investor will tell you, a single quarter's headwinds do not define a company that has a 20-year track record of winning. Intuitive is aggressively betting on the future. Case in point, their massive new international footprint. On August 19, 2026, Intuitive announced a massive $500 million investment to build a 316,000 square foot manufacturing facility in Penang, Malaysia. Operations kick off in 2028, and they'll be creating 1,200 highly skilled jobs by 2032. This is their very first facility in Southeast Asia, aimed squarely at capturing the Asia-Pacific surgical robotics market, a market projected to hit $1.29 billion this year with an 11.6% compound annual growth rate through 2035. They are literally building the physical infrastructure right now to meet future global demand head-on. And they're massively expanding their technological footprint as well. Beyond the Da Vinci and Ion systems, Intuitive is preparing to launch a 4th major platform, this one designed specifically for the gastrointestinal tract. On August 12, 2026, the FDA actually posted a 510(k) clearance for this flexible robotic system. Bernstein analysts estimate that this brand new platform is about 12 to 18 months away from commercial launch, and they view it as a massive opportunity that will significantly expand Intuitive's total addressable market. All right, let's wrap this up with part 5, the verdict, competition, and analyst consensus. So we have very real near-term headwinds battling against massive long-term expansion plans. But there is one final piece to this puzzle we have to talk about: competition. For 2 decades, Intuitive has essentially operated in a class of its own for U.S. soft tissue robotics. But that changed on July 22, 2026, when healthcare giant Johnson & Johnson received FDA de novo authorization for its OTTAVA robotic surgery platform. Make no mistake, this is a big deal. OTTAVA is the world's first table-integrated soft tissue robotic system, and its physical footprint is 30% to 50% smaller than traditional legacy systems. It represents the first truly meaningful new U.S. competitor to the Da Vinci in 20 years. So the natural question is Wall Street panicking about Johnson & Johnson eating Intuitive's lunch? Well, not exactly. Analysts at Oppenheimer argue that Intuitive's entrenched relationships and integration will likely crowd out competitors. You have to remember, Intuitive has a global installed base of over 11,700 Da Vinci systems. Surgeons are already trained on these machines, hospitals have built their entire workflows around them, and academic programs literally teach with them. That level of deep ecosystem-level integration is incredibly difficult for any new competitor to disrupt, even one as massive as J&J. And honestly, you can really see that confidence reflected in the broader analyst consensus. Based on sentiment from 33 analysts polled by S&P Global, the picture remains overwhelmingly positive. Intuitive maintains a strong consensus buy rating. The average price target sits at $477.25, which at current trading levels represents a very healthy 26% upside. You have major firms like Oppenheimer, Citigroup, BMO Capital, and Piper Sandler all maintaining outperformer buy ratings, with price targets mostly hovering right around that $500 mark. I specifically want to highlight Bernstein's take on this because it perfectly encapsulates the current market dynamic. Bernstein, who has an outperform rating and a massive $685 price target on the stock, explicitly called the recent $400 level a strong entry point for long-term investors. They're essentially telling their clients, look past the unchanged guidance, look past the near-term GLP-1 fears, and focus instead on the underlying undeniable strength of the recurring business model and that upcoming GI platform launch. Which leaves us with one final thought to consider today. But first, just a quick final reminder that this analysis is purely for informational purposes and doesn't constitute financial advice. Always consult a professional before you invest. Okay, weighing everything we've talked about, with near-term headwinds like U.S. procedure moderation and Chinese market difficulties directly battling against long-term innovation and an incredible 85% recurring revenue moat,
Is Intuitive Surgical's recent drop a serious warning sign of slowing momentum, or is this actually a rare buying opportunity for a generational medtech leader? Thanks so much for joining me for this explainer, and keep questioning the numbers.